Let's talk about interest rates. You see the 10-year bond moving up toward and maybe touching 2% sometime this year. Can stocks stand that?
We're going to find out, Tyler, I think. I looked back, Tyler, recently here all the way to 1900 and looked at all the months and divided the 10-year yield up into those months where it was below 3% and where it was above 3%. And when it's been above 3%, which is about 3/4 of the time in our history, when rates go up, stocks actually go down a little bit on average. But when it's been below 3%, only about 1/4 of the time, when rates have gone up, on average, stocks have done really well, like 15% annualized performance. And so we're not just in a rare environment, we're still in a unique yield environment where we've got yields that we've never seen in our history. And yes, they're coming up, but I think it's doing more good for confidence that we're no longer facing negative yields or that the economy is healthy enough to push yields up. And it's actually helping stocks gain. The other thing to think about is we're not only coming from all-time record low yields, but we're going to do it this year with some of the fastest economic growth we've had in the post-war era. Current consensus calls for about 4.8% real GDP growth this year. I think it might be closer to 8% when all the stimulus gets added. And if we have that kind of growth rate at a 1.5% yield, I don't think it's going to kill stocks. I think it's going to take higher yield before we get to there.
The context, though, Jim, to all of this is what you said, which is 0% interest rates. And that environment caused tech stock valuations to go high and to some people's eye become stretched. So I think the question may be, do you think rising rates, and if rates go to 2% or so, does that in fact pressure tech stocks specifically? Because there is research done that 80% of the time when the S&P 500 information technology sector is down, the S&P 500 trades down as well, and this data goes back to 1989.
Right. I don't, Melissa, I think technology sector is going to underperform over the next year. I think it's moved to broader marketplace, small caps, cyclicals, international markets are going to do better. But I don't expect that it's the most likely outcome that tech suffers a severe collapse. I think it's going to participate but underperform. I mean, this kind of growth in the economy also benefits technology. It's just that their steady eddy fast growth rate now looks small in comparison to what cyclicals and small caps with operating leverage are doing in a strong economy. So my point is, I would own some tech. I think it might underperform, but boy, you're going to be glad you own a little bit of that on days when the overall cyclical market pulls back and holds up your portfolio value. So that's kind of how I would look at it for the rest of 2021.
All right. Shepard Smith here. Thanks for watching CNBC on YouTube.